Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the S&P and the QQQ moving a little bit higher. However, the market breadth was not all that great today. Most of all your other major sectors, unfortunately, ending in the red. And if it really wasn't for Google and Apple's performance today, you probably would have been bright red on the indexes because you really didn't have much support even from the rest of the big tech names. Take a look at the heat map real quick. You'll see that Google, Apple, and Tesla had some decent days. Shout out to Amazon and Meta, trying to hold it up as best as they could. But Microsoft, NVIDIA, a lot of the semiconductor names down, except for Broadcom, which has earnings tomorrow. And in terms of financials, healthcare, and the bottom half of the market, just nowhere to be seen today. Shout out as well to Walmart and Costco, trying their best to uphold the consumer defensive side of the market. But still, that whole sector did indeed end in the red as well. Now, some of the reasons that the market was weak this morning was, of course, because we got a less than favorable JOLTS job openings report, which came in over 200,000 jobs under the expected target of 7.4 million, coming in at about 7.181. So we continue to be in this economy where the jobs market is a little bit mixed. We're not really firing many people as the unemployment rate is staying very stable, but also we're not really hiring many people either. So the jobs market is kind of just locked in this very awkward position, but we do get more information in terms of the labor market tomorrow when we get the ADP private employment payrolls jobs report. And then on the Friday session, of course, where we get the big one, the good old non-farm payrolls, the expectation for that one is 75,000 jobs. Now, if this one comes in under 50,000, I don't think it's going to be a case of bad news is good news. And I'll explain. You guys remember last year in 2024 when we were getting weak jobs reports and other data, and every time we would get weak data, the market would take it as good news because the market was anticipating rate cuts. This is still true, which is why the markets didn't necessarily fall off a cliff this morning, because what it did do, as a matter of fact, was raise the probabilities of a rate cut. Now the probabilities for a rate cut for the month of September currently stand at 95.6%. That is up from yesterday's read of 92.7 and up from about a week ago when we were in the high 80s, 88.7 to be specific, right? So as of right now, the bad news is currently being interpreted as good news because everybody's looking forward to rate cuts. However, there is a tipping point for that. If you come in too low on both of these jobs reports, tomorrow, ADP, and Friday, NFP, well, then that's going to trigger somewhat of a recessionary signal. And unfortunately, the premise of rate cuts is probably not going to be helping the markets too much. So a lot is riding on tomorrow and Friday's reports. It should be very interesting. And those are your two remaining big volatility catalysts for the rest of the week. So in today's video, we are going to cover a few things together. Number one, we have to cover two earnings reports that came out today after the close, and that is going to be Salesforce and Figma, which unfortunately my big head is hiding Figma all the way down there. Shout out to all the other companies reporting earnings today. You had HPE, you had GitLab, you had Credo, but for now, we'll be focusing on Salesforce and Figma. And tomorrow, of course, you have a big one with Broadcom. Tomorrow, we'll probably do, let's say, Broadcom and maybe Lululemon or something like that, right? So we'll be covering Salesforce and Figma to start it off. Thereafter, we'll be getting into our major technical analysis of our whole market rundown. Take a look at the sectors. How do we currently stand? How is the current market breadth leading into the month of September, which we know is traditionally weak? We'll do that first. Thereafter, we'll dive into our big tech name list here as well. Drive, where are the possible entry locations? You guys know that I've been a big believer in being patient for the month of September because of how weak it is seasonally wise and because of all the macroeconomic catalysts that we have on the horizon, you know, tumultuous jobs reports leading into a Federal Reserve meeting on September 17th. We probably are going to get the rate cut, but it's all about the commentary, right? If the Fed is too hawkish in terms of their view on the economy, well, even with the rate cut, it's not going to look very good for the markets overall. The markets will start pricing in more and more of a probability of a consumer slowdown and an economic slowdown as well. So a lot of macroeconomic catalysts to look forward to. And of course, you have the September seasonality, September being arguably the worst month of the entire year. And of course, we know that the indexes are fairly trading rich right now in terms of we had very nice rallies for the last 4 or 5 months. Monthly consolidation would not look so awkward on these through the month of September, early October, and then get ready for the Q4 push As a result, I have been going slow, so I'll give you some levels to look out for, especially on the higher time frames here on our big tech names. And that's going to be it for today. We will save our biggest gainers and losers of the day for tomorrow. Most of all the names that made their way onto this list today, we covered yesterday, and we also covered them on Friday, so nothing is going to be new across the board right here. They're pretty much all the same players that have been there for a few days running, and to the upside as well. We've talked a lot about the other names on this list. You guys probably know my stance by now on stuff like Oscar, stuff like HIMS. We talk about them almost every single day. So to keep the video shorter, we will do that section tomorrow, because tomorrow we'll probably get some bigger moves after the jobs report. So that being said, that's everything for today's video. Let's jump right into the action, shall we? So SPY up 0.54, the Q's up almost 0.8%, but as you can already see, and I showed you on the heat map, not that much good rotation from the rest of the market. Heat map looking kind of bleak. It was really just a few large players holding up the index for today. You can see that even better on the one-day relative performance, whereby communication services, which, let's be honest, is really only Google, Meta, and Netflix, those were all up today. As a result, that was the best performing sector of the day. Technology up 0.7, but it didn't come from everywhere. You had some key players here and there. Software doing okay today, but a lot of people's favorite names, NVIDIA, AMD, Palantir, Oracle, slightly down and slightly red on the day. And then the rest of the market was pretty much mixed. Energy falling off a cliff today, 1.78%. Where do we stand on the 1 week relative? Well, we know that the markets have been a little bit weak to start off the month of September, not only since yesterday, but also from the Friday session too, which really started the decline on some of your favorite tech names, especially semiconductors, right? So that being said, on the 1 week, well, communication services is leading the charge, but you can see that there are probably a lot more indexes or sectors of the market that are red than green, and breadth is indeed curling over right now. If we take a look at our percentage of stocks above their 20-day EMA, sure, we're still okay right now at about 60%, but it is curling over from the reads that we were seeing a week ago. So you can clearly see some broader market consolidation at play here. Percentage of stocks above their 50-day EMA, that is also curling off of last week's highs, now down to about 60%. Still a healthy read in terms of an absolute number, but you can clearly see some of the markets kind of pulling back right now. And percentage of stocks above their 200-day EMA, not too bad, 58.76. So the market is pulling back slowly, not very rapidly, but we are indeed going into a bit of daily and weekly consolidation. And you can really feel that in a lot of the individual names, right? Especially over the course of the last week, it seems as though whenever we get some nice rallies on some names, they last like a day, sometimes not even a day, and then they kind of pull back. So the market's been struggling to really trend and trend hard. And a lot of our hottest sectors of the last 3-4 months have been doing absolutely nothing for the past roughly 2, 3, 4 weeks at this point, namely semiconductors. Semiconductors was your lead bull, but as you can see right now, we haven't done anything for an entire month. And a lot of technology stocks also look like that, except of course for Google and Apple, which had the continuation of the breakout. But, you know, as we'll run down the tech list a bit later, you'll notice a lot of common themes here. A lot of names are kind of getting stuck at the levels, at the highs that they had established previously in the month of July. And now we're just kind of in this wait and see stance in the markets overall. So that's the short-term analysis on your breadth. In terms of inflation numbers, true-flation still at about 2%. This measures over 15 million individual items on a daily basis. It's much more representative than the CPI or the PCE. 30 million different data points across those products as well. So keep that in mind. And where we stand in terms of investor sentiment, well, we're currently neutral. We spent the entire month of July and the entire month of August in the greed category. Now, this is the first time that we've kind of dipped into neutral since we got that initial scare 1 month ago, almost to this day, when we got the non-farm payrolls, which I'll remind you, dropped the markets about 2%, the SPY almost 2%, and the QQQs almost 2% as well on the 1st of August on that read. So we will see. Is the infamous head and shoulders on the Qs, is that going to play out? Is the SPY going to go into daily downtrend consolidation as well with another less than favorable jobs report? We will see, but I've been playing this week very carefully. I opened a lot of positions on Friday, many of which have since been closed at a profit, and I really haven't been taking too many additional trades leading into this week, nor especially into the Friday non-farm payrolls event. So I kind of want to wind down most of my trades tomorrow and kind of just sit on the sidelines and absorb what happens with the jobs report. If it sends us lower, we'll find some phenomenal opportunities for the rest of the month. And if it sends us higher, it'll be curious to see, can we actually derive the continuation of a very nice uptrend for the month of September, or will we just fall back into our seasonality averages? I'll remind you, since 1945, the month of September has proved to be the weakest month of the year, down on average about 0.6%. If you go to even more recent data, 1996 to 2024, you can say the exact same thing, right? Over 1% declines for the month of September. And if you zoom in even more for the 10-year average, you will see that September, categorically speaking, is the worst month. In the last 5 years, guys, 4 of them have been red, and big red, not only 1%, right? 2020 through about 2023, decent red in the markets. Will this time be the same? Well, obviously, that is the million-dollar question, but let's just say I'm not extremely optimistic for this month. If you're asking me, I'm about like 60% bearish, 40% bullish for this month. But you guys know this already, right? That's only because I'm expecting eventual monthly consolidation, and I think we have all of the fuel, right? All of the catalysts that can possibly send us lower for monthly consolidation would most likely be now, because after that, in the mid-month of October, we get corporate earnings. And for the most part, especially in terms of the guidance that we recently got, corporate earnings should probably be good. So if we can get through the month of September with a bit of consolidation, it's going to allow us to reload on some of those swing trade longs. Perfect, right? And in the event that we keep moving higher, I do still have a lot of leap contracts and a lot of buying power for the wheel strategy. And you guys know, no matter what the market is doing, you will always find some decent plays for the wheel, as every single day, there is some rotation to be had across many different names, many different sectors, and several names are always pulling back into support on big red days. So there's always going to be wheel plays to be had. So let's move into, for the introduction, fairly long introduction, but I figured I should set the table for the rest of the week. Let us move into our earnings profiles. And number one that we're going to be covering is CRM Salesforce. So Salesforce, we know, has had a very tough year. Since January, the stock, it seems, has been only down. And year to date, you're looking at a very bad performance here by Salesforce, down 24% year to date. And sadly, the declines continue in the after hours. Salesforce down right now after earnings, 5.5%. But it wasn't because they didn't post good numbers for this quarter. Matter of fact, they beat on both the estimates, beat on EPS by almost 5% and a 1% beat on revenue. But it all had to do with very soft guidance for the company. Let's take a look at some of the easy numbers real quick. So if you look at the guide for Q3 sales, it came in underwhelming, guys. 10.27 billion is the guide. Expectations was 10.29. So they missed on the sales guide. In terms of EPS, that came in flat, 2.85 versus the expectations of 2.85. They also gave us the full year guidance, 41.2 versus the estimate of 41.2. So still soft, roughly in line, not raising, but they did raise a few profit metrics here. For the fiscal year, you're looking at $11.35 in EPS, which was compared to the estimate of $11.29. So a tiny little fraction of a raise here on EPS and a raise on EBIT as well. If we take a look at some of the easy numbers from this quarter, guys, revenue is up 10% year over year, but I will show you why, even though this is a good number, it's a bit problematic leading into Salesforce's next 2 quarters. So 10% raise on revenue or year over year, not too bad. Remaining performance obligations currently stand at 12% year over year, $60 billion in the pipeline, which is roughly a year and a half's worth of revenue for Salesforce. Operating income was up 12% and EPS up 14% year over year, with a nice little upswing in operating margins. So the moral of the story here, before we get into the earnings presentation, is that margins are improving for Salesforce. They're doing a good job on profitability. However, revenue, sadly, is slowing, all right? So let's move into the article real quick. Salesforce issues weak revenue guidance even as the earnings beats estimates. The net income for the quarter was $1.89 billion, which translates to 18.4% net margins. That was pretty good. And as I was saying about a minute ago, right? They're improving margins, which is very good, but revenue is slowing down at the same time. So even though net margins came in at about 18.5, you can see here, most of all the net margins in the past 5 quarters have been between 15, 16, 17. This is the best net margins that the company has posted in the most recent 5 quarters. However, it's sad to say that it comes amidst a revenue decline, or rather slowing of revenue. Salesforce has fallen out of favor on Wall Street this year due to an extended stretch of meager revenue growth, which has been stuck in the single digits since mid-2024. While the company regularly touts its investments in AI and the advancements in its software and systems, it hasn't been lifted by the AI boom in the same way as many of its tech peers. Going into Wednesday's report, Salesforce was down 23% for the year, lagging behind all but one stock in the Dow and trailing all other large tech companies. Can you guys guess which other company is doing worse than Salesforce in the Dow? Shout out to UNH. The ratio of Salesforce's enterprise value to its free cash flow has reached a 10-year low because of fears of disruption from AI. Salesforce is trying to counter the pressure by selling its Agentforce AI software that can automate the handling of customer service questions. If you don't know, Agentforce is Salesforce's new product. They started coming out with it roughly a year ago at this point. It does a couple things. It's mainly AI agents. It kind of says it in the name, but those AI agents can be purposed by several companies to do a few things. Number one, to handle customer interactions 24/7. Number two, for sales, to be a sales representative as well. And number three, to offer training for employees. Those are the three main purposes of the AI agents that Salesforce is working on right now. During the fiscal second quarter, Salesforce said it was planning to increase the cost of some products and announced its intent to acquire data management software company Informatica for $8 billion. The reason that they're acquiring this company, of course, is because that's what Salesforce does. That's what they've always done, right? It's tough for them to grow organically, and that was one of Wall Street's criticisms of the company in the past 2-3 years. They wanted the company to stop spending so much money acquiring their way to revenue growth. And that was one of the main criticisms that transpired last year. Maybe you guys remember on the channel or not, this was the quarter right here whereby Salesforce stopped doing acquisitions. As a result, raised free cash flow, raised margins, but revenue took a bit of a decline right here. And Wall Street wasn't happy because they couldn't have their cake and eat it too, meaning the company could not generate fast enough revenue growth for them without doing these acquisitions. So now, as it currently stands, the company only generated $605 million of free cash flow. Some of the free cash flow this quarter was spent on CapEx to build out their new offerings for their Agentforce deals, but some of the other free cash flow was spent on that deal with Informatica. So if we take a look at some of the Salesforce slides here, I'll bring your attention to the fact that we are now at 12,500 Agentforce deals. That is up from 8,000 deals in Q1. So nice little increase right there, but that is kind of where the bullishness stops. You can see that several of the largest companies in the world have been using Agentforce to better their customer service and sales training and other things like that. Even a company like Reddit is using that one. And now the numbers at a first glance on this slide don't appear too bad. When you break it down per segment of the business, sales was up 8% year over year, service was up 8%, platform and other, where they have the Agentforce, is up 16% year over year, marketing and commerce up 3% year over year, and integration and analytics 12% year over year, for a total revenue increase of 10% year over year. So you might be thinking, well, that's not that bad, right? I mean, when I show you the year-over-year comparisons, you'll kind of understand why it's not looking the best, right? So here you go. Here's the year-over-year comparisons. Look at last year, 2025, and then look where we are at now. You can see sales was double digits. Service was double digits. Platform and other was also double digits. Marketing and commerce started double digits, but started declining in the last 3 quarters. Integration and analytics was double digits, started declining in the last 2 quarters. As a result, look at this current quarter that just passed, right? They're now single digits for almost everything except for platform and other, which is Agentforce, and integration and analytics, which has had a little bit of an uptick here. But look at sales, guys. It's a big component for the business. Single digits now, 8% in relation to last year's 10-11. Service, 7-8 in comparison to last year's 10-11. Platform and other, that one is doing fairly decent as they're scaling their offerings, of course. Marketing and commerce from 10 to 7-8 to 4-3. Not very good right there. And integration and analytics also down from the peak of 2025 of 25%, now down to 10 to 12%. As a result, revenue totals have been slowing. 13, 10, 9, 9, 9, and now barely holding on to 9 as well. So now you can understand why Wall Street is so hung up on the sales guidance. And when you give sales guidance that looks like this, right? When you just can't provide good enough sales guidance, when you come in with flat guidance, well, that's going to be 9% year over year again, which just goes to show, right? Can the company actually monetize what it's currently preaching right now? Or is it kind of being a little bit left behind? Now, some of the things that are doing well for the company definitely is the amount of remaining performance obligations. So they're able to kind of lock in a few more contracts. You can see that total RPO grew by 12%, which is very good. But then once again, that's offset by the spend in free cash flow that they're using to kind of acquire their way to more revenue, unfortunately, right? So Wall Street wants to see more organic revenue growth from the company. If it doesn't see it, it means that maybe companies just aren't spending that much anymore on software as a service. Maybe they're doing it internally, or maybe they're using their own AI, right? If you take a look at non-GAAP percentage of revenue, that is also doing okay. So they're able to bring down some of their cost of revenues here in terms of, certain portions of the business. It's currently flat in relation to what it was Q2 of last year, but down from the last couple quarters. So that's why you see a bit of an uptick in net margins. Not too bad. So they're increasing non-GAAP in terms of profitability here from about 33.1 up to about 34.3, but not crazy margin expansions right there. So those are all the problems that Salesforce has right now. It's a good company, right? But here is the narrative at play. Why Salesforce is down so much. How this company operates, and I used to use this when I used to work in financial institutions, right, at the bank. So essentially how it works is Salesforce sells its licenses per desk, per employee. Every single employee, right, requires a certain license for the software. And that is how Salesforce packages its deal, right? So if a company has 500 employees, Salesforce will sell its products to the company and base the price off of how many employees will be using the service, right? As a result, because of now, some of these companies requiring less employees because of the advancements and efficiencies from AI, it raises the question, right? Well, are these companies going to be spending less on Salesforce because there's going to be less employees requiring less licenses, and as a result, you have less revenue growth? That's the whole argument behind Salesforce right now. So it's kind of caught between a rock and a hard place. It is indirectly part of the AI narrative. They have AI products, such as their Agentforce business, but also it's being hurt by the AI narrative at the same time, because maybe it can sell fewer and fewer licenses to these companies, because maybe these companies won't have as many employees that will require using the product. So you can see what I mean, but it's like a catch-22 for this company, right? In terms of valuation, if we wanted to give this company a chance, because now we're trading back into the support levels established in 2024 during the tariff sell-off, established now as well, and all the way back here from 2020. The company hasn't done anything in the past 5 years, truly. I mean, sure, we have some peaks right here, but nevertheless, it's back to the same price you could have bought it back in 2020. So is it a good deal? Well, let's have a look right here. At $240, where it currently stands roughly in the after hours, you're looking at a forward price to earnings multiple of 21.14. You might think that's low, but keep in mind, they're just not growing revenue that fast, 8.5% year over year. So if you take a look at their revenue and EPS growth curves, they don't look all that bad, right? EPS curve looks very nice. The company is ensuring that it's doing some good cost control and that EPS will be rising. A good portion of that as well, though, is from the buybacks. They have like $26 billion of buybacks remaining, which is indeed 9.5% of the float. So take the EPS number with a bit of a grain of salt. The Apple effect, in other words. Apple does this a lot. And revenue growth here, you can see, although revenue growth is fairly consistent, it's just not that fast. So they kind of do deserve kind of a slow price to earnings multiple right there. In terms of the PEG ratio, it's standing at about a 1.57. So also not extremely cheap, right? You'd expect a company that's been beaten down so much, that's grown earnings every single year for the past 5 years, to have a much better PEG ratio. Not the case. It's just okay. You guys want to know another company that has like a 1.5 PEG ratio? AMD. And AMD is growing much faster than Salesforce. I know they're not in the same industry, but the PEG ratio is what allows us to compare apples against oranges, companies in different industries with different growth rates and how much you are paying for the growth. Free cash flow yield at 5.1% is probably the highlight of the company. It's a very profitable company. Free cash flow yield is good, and they use that free cash flow, well, number one, to buy their way to inorganic revenue growth, but number two, to do a whole bunch of buybacks. So all in all, guys, it's not too bad. And if you take a look at their balance sheet real quick, right, their balance sheet right here, if I can actually find it. Moving on to their balance sheet here. Balance sheet's pretty good. They generate so much free cash flow, not too much debt, decent amount of cash on the balance sheet, which allows them to acquire their way to larger revenue streams, I assume, right? So all in all, the report, not that bad, but I did outline the problems. So whether or not it's a buy, guys, really depends on your view for Salesforce. It is a very highly used enterprise software tool for many Fortune 500 companies in the world. I've used it myself, of course, a very decent product. They have AI, they have Agentforce as well. And the valuation down here can possibly warrant a bid. Like, you're not getting a bad deal of a company by any metric whatsoever. But is it the best possible growth play in the market? Or is it the most consistent company in the market with a very bright future and a very large competitive advantage ahead of it? Those are questions that I'm not too sure. So I'll leave this one up to you. It definitely is a decent buying opportunity right here, but you may have to be very patient because we know Wall Street's been very picky with their software as a service companies as of lately. So that's everything I had for you guys for Salesforce. Hopefully you enjoyed. Now let's get into another fun company, which is going to be Figma. So Figma, since their IPO, essentially, well, since the first 2 days of their IPO, has just been down and down and down and down, trapping everybody who got way too bullish at these crazy valuations and now selling down, and insiders have been selling out some shares as well. That being said, since Figma's been down, 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 I've gotten a lot of questions on the channel. Is it a good time to buy this stock? You can see that in the after hours after their earnings, they are down another 14%. So now down another 14%. Is the company actually cheap? I'm sure that's what's on a lot of people's minds, right? Let's have a look for earnings. Earnings miss on EPS by about 1.54%, but keep in mind, guys, Figma is coming into profitability right now, so EPS is not the best and most consistent metric for the company just yet. You really want to look at sales. They beat on sales, but small. For a very fast-growing company, you really want to see them completely obliterate sales estimates. Did they just guide too high prior? Do they need to kind of guide lower and then beat substantially, which is a lot of what a lot of other companies do? Maybe, but this is not the best metrics, guys, for a fast-growing company in terms of the sizes of the beats. And unfortunately, because of some lockups that are expiring soon and some insider sales that are probably going to come here shortly, which they did disclose in this earnings call. That is what really brought the stock down, not so much the revenue growth rates, but we will get into everything right now. So let's have a look, shall we? Figma's stock plunges after the company's first earnings report since the IPO. So let's move down a little bit. As you can see right here, revenue increased 41% year over year, which is very strong. They also gave end of year guidance too, which showed that revenue will be slowing down to about 37%, but we'll get into that a bit later. Here's a highlight. Net income totaled $846,000. That's compared with a loss at the same time last year of over $800 million. So the company finally turning a page towards profitability, which is very good. The full year guidance was a little over $1 billion in revenue, $1.02 billion in revenue to be exact, which, as I said, is about 37% growth. So the growth is slowing down a little bit, and analyst expectations are for it to continue slowing, although at a slow pace. We can anticipate maybe 35% growth for fiscal year 2026 as well. Last year, Figma picked up more revenue from customers as it sold them access to dev mode, which helps software developers to implement designs that designers create in the company's software. So not fully AI, it still has some people designing. Figma is a tool, of course, but at the end of the day, there are people using this tool to design. It's not fully AI with only prompts, right? It needs a little bit of tweaking with a bit of a human touch as well. In the second quarter, Figma announced Figma Make, which uses AI to compose apps and website designs based on a user's descriptions, and Figma Sites, which turns designs into working websites. I'll show you some of the partners that Figma has soon, or some people that use these tools. Figma has yet to fully start charging for its AI products, but says it has built the underlying costs into its model. We plan on letting customers know that they have the opportunity to purchase additional AI credits in the future. So right now, it's kind of a freemium service. A lot of their largest partnerships indeed are paid, but some of the more broad-based tools that they do offer, those are still somewhat free with a possible premium subscription being put on top of it. Moving on further, a number of software vendors have faced pressure this year due to concerns surrounding AI and whether it will displace business. Here's what the CEO had to say. I think that the more that software becomes easier to build with AI, the more that people are going to see that the human touch is needed. So once again, referencing their business model, which I touched upon earlier, whereby there is a little bit of human intervention and some final design tweaks for their customers. Figma reported a 129% net retention rate, a reflection of expansion with existing customers, meaning that customers stay in the platform and also use its services more and more once they're inside. That figure, however, was down from 132% in the first quarter. I'll show you guys what that looks like in a graph in just a few short moments. Following the IPO, Figma expects a share sale lockup to expire for 25% for some employees' stock after the market close on September the 4th. This is very important, guys, because investors that hold just over half of Figma's stock have agreed also to an extended lockup with the final 35% of their shares expiring in August 2026. So some will be up for sale tomorrow, and a good other portion of that will be in August 2026. So you can see further selling pressure from insiders, basically employees and people who have had the shares privately prior to the IPO. Very important, kind of like CoreWeave, right? Figma had 1,119 customers paying over 100K in annualized revenue, up from 1,031 in the March quarter. That's up about 10%, so not too bad. And the company had about 1.6 billion in cash, cash equivalents, and marketable securities, with $91 billion in a Bitcoin ETF. Here's what CEO had to say. We're not trying to be Michael Saylor here. This is not a Bitcoin holding company. It's a design company, but I think there's a place for it in the balance sheet and as part of a diversified treasury strategy. So there you have it. Company has a lot of cash on hand. So far, no current plans to have any dilutive effects like some new share offerings, but that'll be important when we touch upon the valuation of the company in a little bit. Now take a look right here. Here are Figma's numbers, and I'll give you guys some pause. If you just look at this one slide, I mean, you can look at other slides, right? But just look at the font. I'll show you some of the fonts here from some of the other slides real quick in Figma. Let me just zoom down. We'll go back through it. If you take a look at this slide, pause the videos for a second. If you guys can tell me where this font and template has been used in another company's earnings report, you are 100% locked in, and a Lamborghini is on the horizon for you. That's how locked in you are. It's just a question of time. You are fully locked in to fundamentals and the markets overall, my friends. So pause the video and let me know, are you able to know, can you guess, well, not guess, but does this remind you of one company's templates for their earnings? Well, here it is. It's actually Palantir. Palantir is the exact same template and the exact same earnings. Fun fact, Palantir actually uses Figma, and they've been using them since 2022. So if you were able to find that, if it jumped out to you as easily as it did to me, you guys are 100% locked in. Congratulations. You guys get a cookie. So here you go. 41% revenue year-over-year growth, 5% non-GAAP operating margins, and 24% adjusted free cash flow margins. Not too bad at all. Here are just some of the few things that Figma does. They take an idea, then they visualize the idea, they build it with the AI code, and then they ship the end product to the client overall. They have several large partnerships. Affirm uses them. We also talked about Palantir. Palantir uses them as well for their AI software and UI. As well, they have a couple other things such as Figma Draw, which is kind of like Adobe in certain aspects, whereby they can derive certain designs just on some text-based inputs overall. And additionally, guys, now they have the Figma Sites, which allows you to kind of build a website in real time using AI inputs. This is going to be very good for the future as well. If you take a look down here, some of their other clients include Coinbase, which uses them for designing the UI around their app, which is very strong too. And a little bit further, you will also see that they have some of the Latin American banks, Itaú Banco, and also Nubank, one of the companies that I keep preaching on the channel. So very fun to see that they have very large customers. Maybe you didn't know some of their customers overall. So these are mostly some of their products: Figma Draw, Figma Make, Figma Sites, and Figma Buzz. So here you go, 41% year-over-year revenue growth, but as I said, it will be slowing down to 37 and then 35% at the end of the next fiscal year, 2026. If we take a look at other things, net dollar retention for their customers, 129%. As you can see, it's down slightly over the course of the last 4 quarters, but it's still very, very, very high, right? But still, you can see in the last 2 years, net retention rate is kind of dropping slowly but surely. And that's good. I mean, that's not good, but that's kind of what happens with a lot of these fast-growing tech companies. Eventually, they hit their maturity curve. Now, here you go. Here's the paid customers. You can see that customers with over $10,000 in annual recurring revenue is now up to almost 12,000. Very good. That is growing rapidly. And then the amount of customers that have over $100,000 in ARR with the business, that is also growing quite rapidly as well. So shout out to them for doing that. 90% gross non-GAAP profit margins, which is very strong. And this does have an effect into what will be their net margin rate. Because we know when these companies start scaling revenue, they have a lot of operating expenses, a lot of R&D, a lot of sales and marketing up front. But as they scale their revenue, if you have very high gross margins, eventually that will translate into high operating margins and into high net margins as well. And this is very important for the future value of the company, which we will try to derive in a few short moments here. So as you can see, 1.6 billion in cash and cash equivalents, which is very good, and a 24% adjusted free cash flow margin, which is not too bad at all. And that's pretty much it for your Figma slides, right? So they don't have too much in terms of forward guidance, not too much at all here, guys. The earnings report was fairly decent, but revenue as well will be slowing. Now, they don't really give guidance beyond next quarter and beyond the end of the fiscal year. So sadly, we do not have anything for next year just yet. We'll probably get that at the end of the year. So with only one earnings report to be basing our analysis off of, and potentially some future growth rates and some margin extrapolations, is Figma a buy right here at $58 per share? The market cap, now down another 14% from the close, would put them at about $30 billion. I'll remind you, Adobe tried to buy this company for anywhere between 20 to 25 billion. I think the actual figure was about 22 billion, if not mistaken. Maybe it's 25 or maybe 20 flat. It's in between there. Tried to buy them about 3 years ago at this point in time, and sadly, it got blocked. So right now, it's currently trading at about $30 billion. Not that much higher than when Adobe tried to buy them a few short years ago. So right now, at $58, is this company a buy? Well, let's look at the current valuation, right? Currently, bringing in about a 1.02 billion by the end of the fiscal year. That gives them a 33 forward price to sales. We can't really derive a price to earnings because EPS is pretty much zero right now. But what we do have is the gross margins, and we can possibly extrapolate what some of their net margins can possibly be in the future. So what I'll be doing right here is trying to derive what could possibly be their revenues through 2028 and through 2029 as well, to kind of give you guys like a 3 to 5 year time horizon on this company to whether or not it's good right now, because we know it's going to be very volatile. Insiders are selling shares, valuations right now in the market are compressing from all the IPOs. Figma's down, Bullish is down, Circle's down, CoreWeave is down. IPOs just haven't been doing too good since the July period. So we want to know, right? Because we're kind of flying blind here. We have no uptrend at all, right? The company, when it came out prior to the IPO, was probably like 30, 35 bucks. It's still well above that right now, but is it a good deal? Well, for that, we need to make a couple assumptions overall, yeah? So if we assume that by 2029, the company is able to scale into positive net margins, we can assume 30% net margins, kind of as other companies have shown, right? Companies that have 90% gross margins, usually they're able to bring about a third of that to the bottom line over time. If we assume net margins, that means we're assuming net earnings as well. We can assume a 60 to 70 PE ratio for the bull case scenario as well. It's a very fast growing company where revenues are, none of this is good up here. So these are not good. I copied this from another page from like the Amazon earnings. I just copy paste the template and then readjust. So here you go. So revenues are growing at about 35% per year, and I've assumed that they will grow 35% per year every year through 2029. We'll do a base case and we'll do the bull case, and we'll do a base case in which I kind of reduce the growth metrics, right? So assuming 30% margins and assuming the company is allowed to trade at 60 to 70 times forward price to earnings because it is growing so fast, both on an EPS scale and on a revenue scale as well. You can find tons of these other examples in the market of companies that trade at forward high price to earnings metrics when their EPS growth rates and their revenue growth rates exceed 30%. This is not so crazy. I think these are decent assumptions, right? But you guys are free to do your own assumptions. We are also going to assume no dilution because of course that's going to change the share count, which would change the analysis. Now, from 35% year-over-year revenue growth, if we extrapolate the revenue in 2029, that is 3.4 billion. If we assume 30% net margins, that gives them a net income in 2029 of 1.02 billion, which is just 30% of 3.4 billion. If we times that by the top end of the valuation range at a 70 forward price to earnings, you get a 71.4 billion market cap. Right now, the market cap in the after hours is about 30 billion. If we take it from the close, though, that gives them a 2029 share price of between $145 to $150. This is the bull case scenario. So overall, you could assume that from right now, if we're looking for 145, 150 by 2029, let's take the bottom end of that, 145 divided by 58 currently, you're looking at like a 2.5x. Not terrible for the next 4 years. I know some of you guys want a 2.5x by tomorrow, but this is not bad for a bull case scenario. However, if we reduce their growth rates for revenue down to, let's say, a 22 to 25% compound annual growth rate, which means next year it's 35, then it's 30, then maybe they slow down to 20 for the 2 following years, yeah? If we assume a compound annual growth rate of 22 to 25%, not 35%, and we assume a lower multiple as a result of that, well, then you would probably get a share price of $90 to $100 if we were to redo this calculation with the below metrics over here, which overall would be just under a 2x, which is also not so bad for the next possible 3-4 years of the share price. So that being said, Figma for me, if you want to know if I'm going to be a buyer for this one, maybe if I can find this one between $50 and $45, I might start a tiny position, but it will not be an all-in position as, let's say, Palantir was for me in 2022, because it's not really cheap, guys, right? For it to be really cheap, you'd need the share price to compress a lot more, like go back down to $30 type of thing. So if you're one of those people that have shares from the IPO, $30, $35, you're sitting good. Your compound annual growth rate is very good. Here at 58, it's kind of manageable, but I would be more interested under 50. Call it 50 to 45, maybe selling some put options in the next few weeks. If I get assigned 100 shares, who knows? Maybe I just keep them and I go for the expansion of the company. Phenomenal product, though, and widely used by a lot of very famous companies out there, and I think they have a good chance of doing well. It's just that the IPO valuation got way too high, and right now we're coming back to, let's just call it some sort of an attractive, more fair value. So that's everything I had for the Figma earnings. Hopefully you guys enjoyed that and the CRM earnings as well. Now let's dive into some technical analysis, shall we? So starting off with the SPY here, guys, we still have, whoa, that's not the right one. So we still have a line in the sand level to be watched out for in the next few days. Talking about this guy right here, 634.59. If you were to lose this, then you lose the daily uptrend and you go into daily consolidation. Pay special attention to those jobs reports because those would be the only ones that would make that happen. Of course, if you breach the new all-time highs, well, then the daily uptrend simply continues at this point, and the next target, of course, is going to be the 650 psychological to crack to the upside. But in the event that you move down, because a lot of people are worried about the downside, what are we looking for here? Well, possibly just looking for a weekly higher low, anything above 619. However, if you come even lower than that into the September 17th Fed rate cut meeting, you're just most likely going to be looking for the infamous monthly higher low that I've been talking about for a few weeks right now. So it should not be surprising if it does happen. You guys should be ready with your buying power and with a shopping list of your favorite names. Prior resistance should be current support, and that'll be the 12 monthly EMA, a very nice area of defense for the bulls. At least it always has been in the context of big bull markets, unless you get a big bear market like this, a tariff situation, or possibly a global pandemic. The 12 EMA on the monthly, very solid to be basing some of your analysis off of. Moving on to the QQQs right now. The QQQs, same line in the sand level, 558.49, the lows of yesterday and the lows of 2 Wednesdays ago. Pay special attention. This is still the infamous head and shoulders. A lot of people are watching for it. In the event that that does follow through, you'll be doing a few things at the same time, right? It will be a daily perpetual downtrend right now. It will also be weekly consolidation. Weekly higher lows are set at 551. If you take that guy out too, you lose the weekly uptrend. And you know, when you lose a weekly uptrend, it takes weeks to kind of get back, right? But the big fallback area, once again, should be the 12 EMA on the monthly, and the big prior all-time high resistance, which is now support, currently stands at 537, down about 509. We're not talking about a huge correction right here, but that would be between 6 to about 8% on the Qs from the top. And it doesn't take too much for that to happen. It just takes a few of your large tech names to pull back in a substantial way, right? 5, 6, 7, 8, 10% from their own respective highs, which would not be too crazy because a lot of them had some really nice rallies for the past 3-4 months. On to financials right now. Financials struggling a little bit on the day today, but trying to protect this guy right here, 53.33 prior highs. They're trying to play some good defense right there, and the bulls are still in control of this very nice daily uptrend. If you give back too much, though, and come below here, you open up the door for the infamous daily downtrend. You open up the door again for very healthy weekly consolidation. The higher lows are still set at 51, and you have this beautiful prior all-time high resistance range, which will now be acting as support. And even on the monthly, it would have looked so awkward, right? Just a bit of a monthly higher low, tag the 12 again, tag all this resistance, which is support for the month of September, would not look so awkward at all. On to healthcare right now. Healthcare just doing absolutely nothing. Line in the sand remains set at 135.76. If you lose this, daily downtrend is back underway, and you're just going into more weekly consolidation. Good thing for the bulls, though, they have a ton of space. They created that space with a very beautiful engulfing move. you'd just be looking for a weekly higher low and try and go for a trend change. If the entire market pulls back, I think healthcare has a better chance of being a more defensive area of the market than others. If people pivot from the risk on growth trade to the risk off defensive trade, healthcare can probably hold up better than most. We also have some beautiful 2021 through 2027 support. The bulls have been using it for a better part of the last 3-4 months. Still a very solid area to accumulate some healthcare plays, as we have a very long-standing 50 EMA that's only been touched really 4 times in the last 15 years and has been a buying opportunity ever since. Healthcare is still one of your more oversold sectors, still one of your more undervalued sectors. As a result, I do have leaps on the entire ETF as opposed to picking one name individually. Moving on to semiconductors right now, what used to be your lead bulls have now turned into your lead range-bound trade, I guess. So doing absolutely nothing since the end of July. Line in the sand stays put at 281.19. Crack that to the downside, especially with the Broadcom earnings coming up. You result in a daily downtrend, the first of its kind, guys, in 3-4 months. And that will be notable to you because you would also be ending up in weekly consolidation. You would be losing the weekly uptrend, the higher low of which is 280. Lose the weekly uptrend, as I said, it's going to be a nice downswing, and it takes a while to get back, right? On the monthly time frame, that would just look quite simply like a monthly higher low trying to tag all these guys, which in my opinion presents a better support area than this tiny little area that we've been building upon recently. This is a much more established level, and that would be down 260 to about 250. That would shave off another like 8 to 10% off of your favorite names, Broadcom, AMD, NVIDIA. So just be patient and look out for it. I'm not saying it's going to happen. I'm just saying if it does happen, it'll be a heck of a buying opportunity. You're looking for the good old breakout, retest of the EMAs, and possibly the rally. So pay attention to that one. The same thing can be felt on SOXX. We're just looking for a breakout here of the prior big resistance range. Breakout, test a little bit, come a bit lower, and then maybe make our move for end of Q3 into Q4. Moving on to the Russell right now. The Russell also doing a whole lot of nothing today, but the Russell's still in control of the daily uptrend right now. We're currently back testing the support 232 down to 225, which is a big level. It's a very big level, guys. It's the highs of 2021. We will see. Can they hold? If they can't hold, then we're just going to be looking for a bit of weekly higher lows, anything above 212.40, looking for a weekly higher low for possible trend continuation. But I've been very clear on this position overall, guys. We're not going for very quick short-term gains here. If you're playing the Russell, you are going for the expansion of the growth trade overall, which is a 3, 6, 9, 12-month thesis with the interest rates coming down over time. So please keep that in mind. The VIX also not doing too much today, but we know that it has a ton of catalysts in the near-term time horizon. Tomorrow, ADP private jobs. And then on Friday, non-farm payrolls. So in the event that any of those two are negative, you will see an uptick on the VIX. The markets will come down, and as a result, we will be able to find some juicy short put opportunities. When the VIX is high, it's time to buy, and the best way to do that is selling puts way under the market into your preferred support zones for your preferred stocks. The interest rates today, 10 and 20-year yields did tumble, of course, because the interest rate cut probability shot up to 95.6%. But as I said, bad news is only good news if it comes in slightly underwhelming. If the bad news comes in way too heavy, then of course, well, that's not going to be very conducive to a good economy, but you will find yields coming down overall, because that means the Fed will have to accelerate its rate cutting path. Pay special attention to this level right here, the area that stopped us out so many times over the last 6, 7, 8, 9 months. If you get a breakdown below, good. If you get a breakdown below 4.7 on the 20-year yield, good as well. Why do I say good? Because if you're in bonds, that will finally be the time where TLT will actually start to rally back to the next level, which right now is about $93 to $90. I'm still a fan of playing this one. It's been an accumulation trade for a very long time. Leave call options or shares, no short-term trades for me. Moving into gold right now, gold actually had a fairly decent day again on the Wednesday session. You can see it was up 0.73%. A little bit extended now at this point, though. The short-term daily RSI, 76, and that's usually a top signal for gold or getting very close to it. However, the bulls are still in short-term control. 4-hour RSI, very overbought, but still in control of the trend. What you need to see if you want to go short is a loss of the hourly time frame. It gives you a better entry for the stop loss. Then you can officially say, okay, That's my local top, and as a result, I can possibly play a small short back down into the support area. If you get the good old breakout retest on gold, I'd be a big fan of looking for it. 3450 down to 3400, looking for the infamous breakout, retest, and possibly run trade. That could be an interesting long in the event that they do show that trade to us in the near-term future. Moving on to Bitcoin right now. Bitcoin actually moving marginally higher on the Wednesday session, up about 0.5%. Not too bad. Engulfing this move now, we will see, because it's been a daily downtrend for the better part of the last, almost a month at this point in time. We will see, can the bulls convert into a new daily uptrend, or will this just be another lower and equal high and send us right down to the range of consolidation again? Keep in mind as well, we are in a weekly downtrend, and the below support is 107 down to roughly, let's call it 100 flat. I'm a big fan of playing short puts under the market in this area and accumulating some Bitcoin positions as we move down into there. You can use your favorite proxy, whether that is some of the Bitcoin miners, whether that is Bitcoin itself, whether that's MSTR, whatever you guys are used to trading. Just keep in mind that Bitcoin should be your guide chart for those types of trades. And as a matter of fact, on the monthly, we are just looking for a bit more monthly consolidation, coming back down into here into previous resistance, which is support, and a curling up of the 12 EMA would not look so awkward at all for this trade, which has literally done that back test a few times in the last year and a half. Moving on to Ethereum right now, Ethereum up 3%, not too bad of a day. Kind of slowing down here by the bears, and now the bulls are looking to capitalize and go for the expansion trade. We will see if they can get it done, but in all reality, guys, if the macro data points tomorrow and Friday are not very good, well, what do you think the risk on trades are going to do? They'll probably crow right back down to the lows, right? So rather than guessing if this is the low, I mean, if you're trying to go for a swing trade long right here and trying to go for the breakout, well, the stop loss would have to go down below there, right? Because if it breaks that, it invalidates your trade setup, and as a result, this is not the weekly higher lows. Looking for expansion, you'd be looking for a bit more consolidation. Consolidation into where? Probably the 4,000 down to 3,700 location. The bulls in full control of the weekly, but might just be looking to consolidate on any macro data weakness. And that would also be looking for a bit of a monthly higher low into the month of September to once again backtest that very same area. That's everything for your market rundown. Hopefully you guys enjoyed that. Now let's jump into some big tech names and then we're done. So looking into Apple right now, Apple up 3.81%. Fantastic move by the Apple bulls today after that news from Google yesterday, of course. So the bulls remain in full control of this beautiful daily uptrend at this current stage. Your higher lows are now set at the lows of yesterday, 227, and we're now just breaking above this little area. I've tightened up some of the support resistance areas just to make them more clear. You might remember yesterday's box was very wide, but this is the next area that the bulls are trying to claim right now. The weekly looks very solid for some further expansion. However, if the macro data is somewhat unfavorable, we would not be surprised if Apple pulls back a little bit into our range that we're trying to break through. And that is once again 236 down to about 228. Not too bad at all. Beautiful for some follow through. And as a matter of fact, I did close some of my call options on Apple today, up 68% from the moment in time where we bought them towards the lows. Very strong move. I was expecting this move to take like 3-4 months, and it only took a month. So very happy to take my gains into the expected move. And of course, that is the resistance area, but also represents a test of the 786 fib. So looking pretty good right there. If Apple bulls get stopped out on the monthly, no problem at all. Tons of space to set up some monthly higher lows. I will be going shopping for Apple again in the event that we have some September weakness and we pull back down somehow into the lower 220 range. But as of right now, the breakout is done on Apple right now. You'd be looking for a bit further a push, and then they can count on this support area, at which point you would enter here, stop loss would go there, and then you're targeting the next range of expansion. So chasing Apple right now, maybe not the best proposition, but on any pullbacks could be quite interesting. They have a nice catalyst next week, which is going to be the rollout of the iPhone 17, of course. On to AMD. AMD down 0.12%, and overall the bulls are still just treading water a little bit, right? So daily downtrend still underway. We will see if this results in more of a sell-off after the AVGO earnings. They're trying desperately to hold on to this support range, which ends at about 156, 157. If you get the further slide down here, no problem at all. You're just going for further weekly consolidation and also further monthly consolidation. This monthly candle close in the month of August does not inspire the most amount of confidence, but what does is AMD's valuation, a very relatively cheap valuation overall for the amount of growth that this company will be putting out over the next 2 years. If we drop one more support level, you guys know me, selling puts down here, 150 to the 140 range, and also another beautiful area to DCA some more shares, and also an area where I will probably be loading up some leap call options for deep 2027 expiries. Moving on to Amazon right now, Amazon up 0.29%. Still, Amazon, guys, doing a whole lot of nothing, right? It's just kind of trapped. Line in the sand remains at 220.5. If you lose that, sadly, the daily downtrend is underway, and as a result, you would maybe even lose the bottom end of the support, which stays put at 218. In the event we have any further weakness and go into some form of an awkward tightening range, or even lose the weeklies and come back down here to about 212, 210, big fan of buying some Amazon shares. Matter of fact, I bought a little bit more Amazon shares today, and I will be buying throughout the month of September if you do follow any more weakness. Amazon valuation in around 220 is not too bad at all. Mid-30s price to earnings and a 1.74 peg. Not too bad, guys. And I'll remind you, Amazon has been one of the companies that's really lagged behind some of the other performers. Amazon, of all the big tech names, is only up 31% in the last 5 years. Now, of course, that's because they had a phenomenal push, better than almost everybody in 2021, but we haven't really gained many levels since then. As a result, Amazon is my favorite play into 2026, 27, and 2028, and I will be probably loading up 1 or 2 more lead contracts in the event we have some pullback, meaningful pullback in the month of September, just looking for a monthly higher low in around this 12 EMA, talking about 215 down to about 210. Moving on to Google right now. Google, fantastic move by Google, guys. 9%. And of course, that's because of the Department of Justice headline yesterday, which said that they would not have to divest Google Chrome, they would not have to divest their Android operating system, and that they would not have to cancel their deal with Apple. Look at Google. Obviously, we've left behind a very large gap, but we did the valuation yesterday of Google, even up here at 225, guys. Is it expensive? I mean, if you look at the chart, you might think that you missed it. But look at the valuation on Google, guys. Still low 20s, forward price to earnings multiple. Still a 1.56 peg. Still very attractive. Now, obviously, everybody's probably going to feel bad buying it up here because of what you could have done, right? If you're watching the channel, you guys probably have tons of Google shares because we were buying the heck out of this stock. I was like screaming it from the rooftops overall. In the event that you get some give back over the month of September, of course, with the gap fill, anything above 208 will be looking for a higher low. Decent time to DCA some shares. Very tough, guys, to start a swing trade position right here or buy some call options right here. Very, very tough to do so. If we do come back for XYZ reason, though, and just consolidate a little bit, kind of like something like Microsoft and Netflix have done after phenomenal moves, you get some consolidation, maybe then we can explore some swing trades. But as of right now, I'm just holding the contracts that I have. We have leap debit spreads from here, and they are now up finally 2x from the moment of entry, and mine are good till June 2027. So I'll be riding those probably all the way up, probably close to 300. 280 to 300 is my target for 2027. Moving into Meta right now. Meta up 0.26%, but still very soft, right? Daily downtrend on Meta. We will see. This is a level, right? The level we've been watching, roughly 735-ish. If they keep losing this daily downtrend, you will be filling the earnings gap, which is all the way down here at roughly, call it 700. You also have a nice area of support down here, 710 down to about 680, that roughly 10% range. It's these guys that used it as a temporary level, but on the higher time frames, right? It is also looking pretty good. That is going to be just above the monthly 12 EMA, which is curling up. So in the event you keep losing your short-term timeframes and Meta keeps consolidating and gives back everything from its earnings, a full weekly engulfing move, it's not going to look the best on the weekly timeframes, but just understand what's going on here. Looking for a monthly higher low. I will be sitting here to buy some Meta down here as we curl into the 12 EMA. Also going to be a fantastic location, guys. 700 down to like maybe like the 660 pocket. Very good area to be picking up some shares. So I'll be closely watching it during the month of September if tech continues to show some weakness. Moving on to Microsoft right now. Microsoft trying its best to stay green today, but very weak overall. Microsoft's just been down, down, down since their earnings. Blow off top, trapped everybody, and now kind of just running away with their money. So the area that they have to break to the upside, 510. If you want a new daily uptrend, give me a 510 break. Then we can talk about the weekly higher lows being set around the weekly 12 EMA. If not, daily downtrend will simply continue at this point, and then you might be looking for the full monthly consolidation phase, which Microsoft does more often than you would imagine. So that level would be all the way down here at about roughly the 465 area, lining up with the 12. Beautiful monthly consolidation, and probably back there is where I would be playing Microsoft myself, as right now, close to $500. The valuation is still a little bit too rich for me. I bought it all of last year at the range lows. I'm just riding my shares. This is the next area that I'd be interested in Microsoft again. And I've been patient for it, guys. I've been saying this the entire way up. waiting for the pullback. Now maybe it's finally here. Moving on to Netflix right now. Netflix not doing too bad today, I will admit. 0.99% to the upside. Call it 1%. The area still needing to be held is 1185 to the downside. If you break this with any jobs market weakness and tech weakness, sadly, you are going to perpetuate the weekly downtrend, and you're heading into the lower level, which is 1155 down to about 1110. So please keep that in mind. That would just be a continuation of the weekly downtrend and healthy monthly consolidation continuation, kind of like Microsoft, maybe back down to the 12 EMA. 1060, 1050 would be the next area of contention for the bulls right there. So short-term price action is not looking too bad. You need really a break and close above 1235 to really cement this as a daily uptrend and really give the bulls a chance to go for the weekly uptrend. But if the whole rest of the market keeps being weak and keeps pulling back, Netflix is not just going to pull a rabbit out of the hat and do it on its own. So please keep that in mind. I'd be more interested in Netflix under 1100. 1100 down to about 1000 is the kind of pocket that I'm looking for to accumulate a bit more shares. Moving on to NVIDIA right now. NVIDIA remains a little bit weak here in terms of sentiment and in terms of price action. Daily downtrend into the closest area of support, that we have. Now, granted, it's not a very big level, but it's the only one we have, right? Because the bigger one, of course, is all the way down here at 150 to 140. So in the event that NVIDIA weakness continues and we get a furtherance of the daily downtrend and a further weekly consolidation phase for the markets, just look for the monthly higher lows, guys. It's so simple. NVIDIA does this more often than maybe you guys can remember, but it does do this quite often in its history, right? And if this is just another one of those times where it has to pull back and consolidate after a very strong rally, I'll be sitting right down here, mid 150s to 150 for the back test of the support range, the bigger one, and the 12 EMA as well. So I'll be looking to sell puts on NVIDIA off of any weakness whatsoever. We did it after earnings. Their valuation is not too bad at 175. At 150, it becomes really manageable. At 150, it becomes like on a forward 2026 basis, guys, it becomes really, really, really attractive, right? At 150, let's say, if they do pull back there, 150, 155, take a look at their EPS. For 2026, right? 2026 is 631. If you get like a 155 strike in there and buy some shares there, 155 by 631, that's a forward price earnings of under 25. Pretty good for a company like NVIDIA, right? So pay attention to the pullbacks in the 150s. That's where you're going to see me start to strike as well. Moving on to Tesla right now. Tesla up a 1.44%. They tried their best. Tesla at one point was up today 3%, but once again getting rejected by resistance. 360 down to 340. Tesla's chart is extremely messy right now, extremely messy. One thing that clears it up, though, is the weekly timeframes. No break above the resistance range, no continuation of the weekly uptrend. If the markets remain a little bit weak in terms of tech, you're coming right back down there and revisiting the bottom of the support range. Let me just erase this because this move is completed. You just come right back down here and get stuck in this range. We've just been range bound for a better part of the last, 4 or 5 months since the month of May. Come back down here. You might get me interested for a bit of a swing trade, but nothing really for me to do right here at these range highs, unless, of course, you get the breakout. Give me a breakout to like 400, the breakout, the retest of this range as support, then I'm interested for further longs. But taking longs here into resistance and just crossing my fingers is not the type of trade that I enjoy doing. Moving on to Palantir right now. Palantir bulls, you got to give it to them. They're playing some really good defense here around the around the 50-day EMA, right? Around the mid 150 range. The support area below us stays put at about 150 down to roughly 140, this 10-point range right here. We will see if they can get it or not. The line in the sand remains at 142.84. You give that back, it's the daily downtrend. It's the infamous weekly consolidation phase. For Palantir, the weekly higher lows are 128.57. And I'll remind you, in the event we give all of this back, look at the higher timeframes here. The monthly candle close in August was not the best. We have to admit that, right? However, we're just going to be looking for a monthly higher low at that point in time. And the larger area of support that I would be interested in starting to play Palantir in a bit more of a heavier fashion would probably be down here like 130 down to 120. Palantir's done this a few times. How many times did it come back after nice rallies and tag the 12 EMA? Quite a few times. As a matter of fact, here, when they blasted through earnings and gave it all back, that's exactly where we came down to after tariffs. So if the month of September is unkind to growth stocks, that would not be out of the question so much at all. I'll be looking for some big red days on Palantir to try my hand at selling puts all the way down here. And we've got some of those trades in the past 2 weeks, twice as a matter of fact, on big red days have I been able to do that in this area, sell puts all the way down here on Palantir. So you'd be surprised when the VIX really rallies a little bit, you'd be surprised what good distance you can get on a lot of these names. Moving on to SOFI right now, SOFI down 1.69%, so the bulls still struggling a little bit right now. Daily downtrend into where? Into support, 24.31 down to 22.20. The weekly timeframes are not looking too bad right now for the bulls. It's still a nice weekly uptrend, just into some weekly consolidation at this current stage, and a lot of support to be kind of counting on the bulls to play defense in, the highs of 2021 to be specific, right? However, if we give everything back and tech really starts falling off and we lose a couple of the moving averages that we've been defending for how long? For the past 3-4 months, right? We're starting to lose them now. We lost them back here. The bulls instantly responded. Tried to lose them back here. The bulls instantly responded. So if you get some big red candle closes below the 12 EMA on the daily, something that really hasn't happened a lot at all in the past 2-3 months, that has to be notable to you. It's a shift in momentum. As a result, you will expect further weekly lows and possibly a bit of monthly healthy consolidation. As a result, I'll be playing this one in a couple different ways. I'm now selling puts here at 23.51, but not too many contracts because I want to leave the door open to DCA into this trade. Some here, because if it just rallies, at least I'll be collecting some premium, but I'm saving some money to DCA here, lower 20s, and at the worst case scenario, 18, which would be a retest of the 12 EMA, which SOFI has done when the markets have gotten a little bit dicey in terms of our favorite tech names. So 23, 20, 18 are going to be the levels that I'll be looking for in the upcoming few weeks in the event that it's bad. But as of right now, I'm not selling any SOFI shares. I bought all the SOFI shares that I wanted to, all the way back here, essentially. But right now, in terms of the valuation at 25 bucks, is it a bad deal? No, you can make that argument. It's only trading at about a 9 forward price to sales, but just don't get too greedy, right? Now is probably not the time to go all in full YOLO when you know that the markets are a little bit on edge right now. So please keep that in mind. Keep the bets small and try to DCA the contracts as we move down, especially if you're doing call options. You really have to put a lot of time on those. Moving on to Uber right now. So Uber still very choppy. The bulls are trying their best to defend this area. 93 down about 90.5 is going to be the support zone that we're trying to defend. But, you know, we had a fully engulfing move. If you give me the lower high and the lower low and crack below support, the clearest time frame, in my opinion, for Uber is the weekly. It is a nice weekly uptrend, but the legs are getting smaller and smaller. So if you unwind this completely, that'll be more weekly consolidation, and it'll be, unfortunately, monthly consolidation too. Where could we possibly head back into? Well, maybe the 12 EMA, which also lines up with beautiful prior monthly resistance, which will be current monthly support. 12 EMA is there. Give me a back test to the low 80s, and I'll be a big fan of building some swing trades here and possibly adding to my share position as we stand right now. And around $90. The valuation is pretty good, so if it comes back down 10% lower than this to the low 80s, I'll be a big fan of possibly buying this stock. And now lastly, TSM trying its best to hold it up today, 1.31% to the upside. Big earnings tomorrow from Broadcom. Broadcom earnings will probably be very good, guys. So are NVIDIA's, and the stock still dropped anyways. Keep in mind, Broadcom is up a ton, an absolute ton from the April lows, guys. From the April lows, Broadcom is literally up over 2x. Over 2x, right? So we will do the earnings together tomorrow, but in the event that the NVIDIA effect happens, you would possibly expect TSM to drop the very next day as well. The bulls, they tried, and they're trying again, but the bears are getting more and more control, right? We're under some of the short-term moving averages, which is something we have not lost in the last 3-4 months. That has to be notable to you. It hasn't done anything in a month since their own earnings, which I'll remind you were insane. They were very good. Demand is through the roof right now, but still, very natural weekly consolidation, and as of right now too, very natural monthly consolidation. If we bring us back to the 210 to 200 level with the monthly 12 EMA, big fan of buying the dip on TSM for some long positions in terms of call options potentially, but also selling some puts down here and accumulating some shares for our long-term portfolios. As we know, the valuation of TSM here at 230 is pretty good. So at 210, 200, it gets even better. It becomes almost a no-brainer trade, especially with the amount of guidance that they gave us just about a month and a half ago at this current point. That's everything I had for you guys in today's video. Hopefully you enjoyed. If you did, consider dropping a like. I would appreciate it for the growth of the channel. Consider subscribing if you're new. Would love to have you back. We do these every Monday to Friday after the close. And last but not least, if you guys have any questions, feel free to leave them down below. I'll be answering all questions tonight. And lastly, If you guys were interested in joining a community of over 200 members of traders and investors such as yourself, where we trade the markets every single day and have a very fun time in doing so, you might consider joining our community. In the community, of course, you get access to all of my direct trades, whether those are the wheel trades, the call debit spreads, the leap call contracts, which you make a lot of money on. We just closed a nice Apple contract today, 68% on those contracts. Many of our members had several of those contracts, and I did as well in multiple different accounts. You get access to all of the trades. Here are just a lot of the trades that we've been having over the past few months or so. The green little check marks are wins, the red little circles are losses, of course. And you get access to all of those trades in real time as I put them through. You also get access to our private morning live streams Monday through Friday, where I stream live at the open and trade for about 30 minutes, an hour, and then take all your guys' questions on all your stocks, your options, or your long-term portfolios. So if you wanted to learn from us and learn from me directly and ask me direct questions on some of the trades that you have going on or how certain things work, that is the best place to do it, because I can explain everything to you in real time using the charts and everything like that, and the options chains, of course. And if you can't be there, the sessions are always recorded, and feel free to ask me all your questions in our chat rooms all throughout the day. I'm very fast to answer. You get access to our private video educational section as well, where I teach technical analysis, fundamental analysis, different trading strategies with options, how to grow accounts, how to build long-term portfolios. So much educational content right there. And last but not least, as a bonus, you get access to all of my charts, all of my watch lists, all of my charts whenever you see support resistance levels on hundreds of different charts. And whenever I do these earnings breakdowns, all of that comes, you can copy paste all the charts. It takes 10-15 seconds, just an added bonus for our members as well. If any of that interests you, the link to the Discord is down below in the video description. Hopefully I get to see you guys in there soon. And if not, I'll see you right back here on the channel. That's it for me. Take care. See you tomorrow after the close. Peace.